Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 260 for April 13th, 2020. My name is David Kosmeter. I'm the creator of TimingResearch.com. And today we will be discussing the markets and report number 342 of the weekly reports that I publish. So today we are going to be doing something a little bit different. If you're a regular watcher of the show, you know that this one we've been doing for audio only for the last few months, and but that hasn't been working quite as well as I would like. So we're going to try something new, where I'm just going to share my charts, or I have the Yahoo Finance charts up right now, and whatever the guests talk about, I'm just going to put the charts up that they want to display. So I have Jim, the option professor, back today, and Michael Filighera. So I'm going to go ahead and turn it over to Jim.
Okay, thanks a lot. Michael, before we get started, just a quick background on yourself and a little bit on logical signals, please.
Sure. Again, my name is Michael Filighera, and I am the owner and the proprietor of logicalsignals.com. The website continues under reconstruction, I should add, but I'm very close to getting that reopened. And once it is reopened, I am going to be providing daily analysis and more of just my view of what happened that particular day in trading. The focus again will likely be on or just surrounding futures. So mainly the S&P, the NASDAQ, the Dow and the Russell on that one, depending on which is moving. And then also I love to trade gold, so I will be including gold and crude oil, which are two commodity futures which are very popular as well. My trading history is that I began as a options market maker over 40 years ago on the Pacific Exchange. I've traded here in San Francisco, I've traded in London, I've traded in Amsterdam, and I've traded in Germany, because I did live in Europe for quite some time in my youth, I should say. And now I'm back here in the United States and have gone to day trading futures, primarily to move away slightly from options volatility and options premiums that really kind of can kick in very easily during these times of high volatility in the markets in terms of price. So I'm basically just a day trader, really enjoying it, and I look forward to contributing to today's conversation.
Okay, great. Let's, with the option professor, by the way, we have a weekly market update that we send out, and I'm going to be going over some of the things that I've been addressing in that letter, which if you haven't received it, you've obviously missed out on. And also, I am going to be discussing a twice a week market update that I am considering. And I'll be asking at the end of the broadcast for you to email in what type of areas you'd want me to cover. Just a quick background on myself. I've been doing the investment business here for decades upon decades upon decades. And I've been doing option webinars and seminars live for hundreds and hundreds of times, with thousands and thousands of investors have attended. So, at the end of the day, I do have a certain amount of knowledge. And what I try to do is share that knowledge and experience with you and give you my two things, my opinions and my observations, and basically what I'm focused on as far as what's on my radar. Let's put the S&P chart up there, and let's, Michael, I'll give you first crack on what you think, and then I'm going to chime in with my opinion. So what do you see here on this S&P, and what do you think?
What I see on the S&P currently is that I think that the bounce that we saw off of the lows up to, I'm going to say, last week's highs, look to have completed this particular phase. And if we take a look at that spider chart, we can see it pretty clearly. And that I also use Elliott Wave. And on this particular one, we had a very clean off of the all-time high in the spiders down to that late March low. That was 5 waves down. And 5 waves down are normally going to be followed by a 3-wave rally. And that's pretty much what we've now seen, in the markets are just beginning to turn lower again. And so I continue to go with a lower forecast for the week. Um, and I'm giving that about a 70% probability right now.
Yeah. With regards to my opinion on this, just to give you a little background, if you've been receiving the market updates every week, here's what you've missed out on if you haven't. My view going into the year is that anything above 3,000 was made out of baloney, meaning the move from 3,000 to 3,400, you had no earnings. The advanced decline line was totally non-confirming, meaning it was a divergence between the advanced decline line and the RSI and the new high. That's a very dangerous sign. And then, of course, GDP was nowhere to be found. They kept talking about this fourth quarter, we're going to get a pickup. 2017, 2018, 2019, the earnings were really not that much. And only through some special factors did the GDP get above 2. Having said all that, what that means is that this thing is not going to be able to last, because things that don't make sense don't last. And so my feeling is stay away from the market above 3,000. And then once you broke under 3,000, and certainly under 2,850, and then of course all the virus talk, the likelihood of a very big drop was also quite high. The moving averages on the S&P, which I follow, was way down in the 3,000 area while we were up at 3,400. That's obviously ridiculously overdone. So once you broke the 200-day around 3,000, that was pretty much all she wrote, as you can see. So what happens then is obviously you get a cascading, and all the things I was warning about last year, and obviously for quite a while, is that people plowing money into ETFs, plowing trillions and trillions, and then what they call passive investment, which you can also call falling asleep at the wheel, and complacency. That became a real big problem, because if you really know anything about the market, which after decades I know plenty, is that it's a little bit of a scam, in that what? You're getting involved in these things that have a per share price, right? But what's behind the curtain? What's behind the curtain is illiquid investments, like in the bond market, where you have to go from dealer to dealer hoping they buy it. Do you think if the markets are collapsing, a dealer's going to take his checkbook out and throw it into a bonfire? Of course he's not. And that's why the Fed has to come in, and that's why the dealers know that's going to happen. And that's why the Fed now has to buy everything, because they're the bid. Okay, so the bottom line is if you were listening to my situation when we were up at 3,200 and 3,400, I was talking to you about hedging. Now, if you don't know much about what I'm talking about, that's why you need to get the weekly update, and that's why you might want to check in on the twice a week update as well, because I know how to work collars, where you sell the out of the money call and buy a put with the proceeds, and now all of a sudden, rather than losing all your money on this big drop, you would have had something to give you upside potential, because it was an out-of-the-money call, but you would have had a floor under your equity. And that, in most cases, would have been very, very, very advantageous to the investor. The other things, of course, is married puts. The other thing is called changing your what? Asset allocation. You know, when you're up at 3,400, the index is down at 3,000, you've got a virus going through the world, and there's no real growth in the stuff that keeps the thing going, which is GDP and earnings. You got to put some protection on. Now, I can't tell you to do that, because maybe it's going to go to 3,900. And then, of course, you'd be mad you missed out on some upside, right? But if the odds and the probabilities are of a rollover, you can change your asset allocation. If you're 60-40, which 90% of the world seems to be 60% stock, 40% bonds, then what you do is you go to 80% bonds and only 20% stock. And then when this drop happens, maybe you lose 10% rather than 30, 40% or worse. When the market comes way down to the bottom here, obviously your asset allocation model has to change, because now your bond portfolio has really gone up and your stocks are way down. And maybe down here, it's time to switch back to go to 60% stock again and 40% bonds. And that's where you would be right now during the rally. So, you know, the weekly update that I give, and the, and the opportunity to email me or get an update twice a week could possibly help you navigate some stuff. Because if you're just going to listen to people on TV, who probably are always long stocks, and they're probably always going to tell you to stay in there no matter what, may not be right up to your suitability because of your age and your income and everything else. So you might want to take a more active approach, because the passive investors now are just hoping that the Fed and all the printing will bring us back up, which it may or may not. But if you're retired or something, you obviously may not be able to put all your faith in that. So again, right now we had the big drop down to 2100, and the distance between 3400 and 2175, and a 50% throwback, or right down to where we broke down from, is what I talked about in last week's newsletter, 2790 to 2850. That's the zone that it's probably going to fail from. And of course, right now it is failing that. If we don't fail here and we get going, my view is we could go up towards the 61.8%, which also coincides with your 200-day moving average. And that brings the number 3,000 into play. That's your best case scenario in my view. And then, of course, on pullbacks, again, 2450 is your line in the sand, right? So that's your line in the sand. If you want to buy a pullback towards 2640, where we stopped before, you see, 2640, that's a place if you wanted to play the long side that you could take a shot. And then underneath that, 2550 to 2450. So if you wanted to know the zones that I'm watching on pullbacks, 2640, and on the downside here, 2450 to 2550. And again, if you take out 2450, then all those negative things that they talk about, like retesting the lows or a 61% drop to 1700 or 2000, that would be back in the cards. But right now, what's in the cards is the market has turned. And what else is in the cards? You've got support at 2640, those highs, and then you've got support between the 2550 and the 2450. So those are your two zones to, in my view, trade against at this point in time. The lows are not on the picture right now. So looking for new lows and all that stuff is not realistic in my view until you violate some things like 2640 and 2450. And again, with the Fed coming out with this kind of push, people have been looking through 17 million people being unemployed and nobody going to work for 2 months. And they're totally focused on 2021, 2022. And if they can continue to feed people that serum or whatever they're on, then this thing will not go back to the lows, because you're going to need another violent amount of selling. And where's that violent amount of selling? Because we've already deleveraged everybody. If you were on margin, you're probably gone. If you were short anything, if you were selling puts, you're probably already gone. So that wiped out all those people to a large degree. And that's why you're bouncing back up, because it's all about if everyone's long up here, the algos will press the short side. If everyone is short down here at the bottom, they're going to press the guys on the short side, and they're going to press the buy side. Okay. But now that they've pressed the buy side up here, obviously they could do some pressing on the sell side again, because we've had such a nice run from 2175 up to 28 and change, which is a pretty darn good run. But it didn't run up for no reason. It ran up because illiquidity. Right down here at the bottom, you're running out of sellers. So boom, you run it up. Now, of course, you have a lot more higher prices. So if people think things are still overvalued, the CAPE ratio is 24. It's still a high level, not as high as 43, but stocks are not cheap here. And so that does give you some vulnerability. But let the market dictate what happens as far as what you think. But again, the VIX is really telling you every day you walk in, you can expect 3% up or down, because 16 VIX is a 1% volatility. A 32% VIX is a 2% volatility. And what's the volatility on a 45? About 3%. And today we went down almost 3%. And people are probably very surprised, but I'm not, because I know when the VIX is at 46, I've got to anticipate a 3% volatility every time you walk in, because that's what the VIX is representing.
Right.
So anyway, that's some of the stuff that I'm seeing. And again, I think people would be very, and of course, the other strategy is when you get way down here and you are talking about Boeing at 90, or you're talking about Apple down at 220, you can look at, and the VIX is at 46, you look at put selling, which is what I talked about in my letter. And if you don't understand it, you can get the update. And why would you sell puts down here? Because as I was showing people, you could get 100 put on the on Microsoft, and you're willing to buy Microsoft for $100, and they give you $5. You could have bought Apple, excuse me, you could have sold the Apple puts for 150. You're willing to buy Apple for 150, plus they're giving you a premium. On Boeing, you could have been willing to buy at 65 and collect a premium. Now, again, you have to have the money to buy the stock if you're put the stock. The other thing is you can take the premium of what you did, which is what you sold, right? And you could buy calls with that. In other words, say when we're at 90, you sell the puts at 65 on Boeing, and you bought the 110 calls. Boeing went back to 180. You could have made $70 on that advance, and you still are only still signed up for 65 on Boeing.
Right.
So again, if you do this stuff for decades and decades and decades, and obviously you've been through all types of, education through the whole process, obviously you have a nice menu of things to do when you look at the markets. And again, you look at what probabilities would be. And again, nobody knows what the future is, but you do know that if you're signing up to buy Microsoft at 100 and it's 150, that's what you're buying. You're buying a company that you really want, and you're buying it at a discount if they put stock to you, or you're going to collect cash. And again, you can take the cash and buy calls if you'd like. That changes the risk of the strategy a bit. But again, that's where, if you need details, getting the weekly update and also emailing me with any questions would be very helpful. So again, that's my current stand on the S&P. And, right now it is on the defensive, as Michael was saying. The rally that I was talking about, 50% off the bottom, off the correction, and also into where we broke from around that 2850 area. That's the zone where it should be failing from. And today, so far, it is failing from that level.
Right. If I may just step in here for just a second, that was so extremely well stated, Jim. And I just want to say thank you, because that was put it all encapsulated, and it was brilliant. And
yeah,
I
it's
just
like you want to give people some clarity, because obviously people need a little clarity.
The clarity.
Yeah.
But I think what provided some additional clarity is how to really look at these types of moves and how to use them to your advantage, instead of walking in saying, well, I'm bullish because my position that I've held on to all the way down needs to have more upside, so I'm bullish. Instead of just looking at it on a non-emotional basis and going in and saying, okay, I bought all of that, I need to protect, or I need to switch things around so that I can make money going down, going up, and going all the way around, because that's essentially what's going to happen. I think when I was actually a little bit surprised to see some of the comments that some of the listeners and respondents were making in terms of their call, that they want the market higher. And I just find that unproductive, and it just takes you out of your focus on which is really needed here in the market. In my opinion, the markets are traded quantitatively. They are not traded fundamentally. They are, but not as hard as they are quantitatively, nor are they as technical as they used to be. So computers are all set up for numbers. All of the moving averages that Jim and I talk about equate to a number. And when that number is triggered, that could trigger a buy or a sell or whatever needs to be done by that particular firm that's inputting all of that data. So, and it goes with the options as well. When you're talking about options premium, those algorithms are out there searching for that premium. That's what they want to find. And they're going to be buying or selling, or they're mostly going to be selling that premium and then doing the corresponding hedge in the underlying. And for them, that trade is now complete. They then exercise or get exercised that night. and everything's off their sheets. So they continue to make money on a quantitative basis, and I'm lots of money, and they walk in every day clean, fresh, and are able to go. Where we wrestle with, well, I have this position, I bought in at 3,300, and now what do? I watched it come all the way down, I didn't make any adjustments, and now it's moving back up. And so I'm angry with everybody else that doesn't want to cooperate with an upside move. I'm angry that, you know, someone is saying that the market should go down. Now, understand as well, as Jim alluded to, but I'm going to say it straight out, these large banks, they manipulate, and they manipulate to their own favor, not to anybody else's. So, for example, I see Goldman Sachs, who during this initial drop down that we had, came out and really put on like, all bets are off the table, we're bearish, and you better just sell out everything and get short. And now they came out and somebody above said, you got to tell that the original analyst that he has to abandon that idea, the bottom is in. And I think that is the call that we do not need to have.
Well, again, you know, they have to change their opinion. You know, before he made that opinion, they maybe did not have so much stimulus or relief coming in. So obviously, once you go up to $10 trillion on the Fed balance sheet, you got to factor that into your situation. And that's why people have abandoned, you know, again, that's why people have abandoned the drop to a new low, because, you know, with regards to the amount of money they're putting in, they are basically going to be the backstop on all the things that people would be selling.
The government's the backstop on the bonds. I totally agree with you. And I watched them buy all the junk bonds from the oil debacle. And they did all that. They just didn't tell us that it's really taxpayer money buying all that junk. And now they're stepping up to the plate.
Well, I mean, anybody who knows genius, you don't have to be a Phi Beta Kappa. If the Fed is doing something or the Treasury is doing something, it's taxpayer money, because that's what they work with. So, you know, anybody who doesn't know they're using taxpayer money, you know.
There's a lot of people that don't see that.
Well, some, you know, like I say, that's their fault. That's their fault.
That's true. It is their fault. Yeah. My point is that I think it's much smarter to not let your position talk, but to look at the numbers and trade more quantitatively and just move with the market. And don't worry about what Goldman Sachs is saying. Don't worry about what the White House administration is saying. This is not a political move. And the coronavirus is by no means political. So to politicize it is dangerous. And I think it's like, come on back to the market. Jim just laid out some superior analysis and how to get around all of this. And he's making suggestions on how you can do it. Now, I agree. It's like, if you haven't contacted Jim, you need to, because this is someone that'll help you get through all of these problems, where you can contact me and I'm going to be more in line with, I'm going to show you how to trade every day, to go in and out every day and to make money. But if you're trying to work a larger position, your task is to get to Jim and find out how you can.
Yeah, I mean, I'm not interested in the day trading, because that's just not my cup of tea. And every type of trading has its positive and negative. I'm thinking more from the terms of, you know, if you have a larger amount of money and you're trying to, you know, put it in a perspective, you know, put it in some kind of perspective. That's where, you know, if you're an asset allocation guy, you know, if you're 60-40 and you can see that the 60 is now 80 because you're at 3,400 on the S&P, you got to rebalance. And that means cut back stock and add bonds. If you find out at 2175 that your 60-40 is now 40% stock and 60% bonds because the bonds are gone through the roof while your stocks have collapsed, you've got to rebalance. And rebalance means you're going to dump your bonds and buy stocks. And obviously that's what rebalancing means. And that's where the quant guys are coming from. They're saying up at 3,400 that it's an imbalance. And if you press the sell side, you're going to be able to hurt people. And that's going to, and it's out of balance. You know, there's too much long stock, too little long bonds. And now when you tank the market, that's what the quants are saying. They're saying people are going to rebalance. They're going to dump their bonds because it's too heavy of the percentage now, because they've gone way up and your stock portfolio's in the toilet. So how do you rebalance something that is down here? You sell the one that's made the big money, which is bonds, and then you add to your stocks. And obviously from this advance of 2,200 to 2,800, that has been genius. but they're not going to call you and knock on your door and go, it's time to rebalance your portfolio. You've got to look at it and know that if the market has collapsed on the part of your portfolio that used to be 60% and now it's only 40%, that you're out of balance. And if you want to be a 60-40 player, which a lot of people have to be in certain investments, because that is the credo of the prospectus, then they have to rebalance. It's not a question of do they want to or not. They must rebalance because they're supposed to be in a 60-40 relationship. So when you hear the word rebalance, when you hear the word quant, these are some of the things they're kind of referring to. Something that I'm familiar with from decades and decades and decades of working with it.
Again, I totally agree with you, and thank you for further defining, what it is you're making reference to. I'm just saying they need to contact you in order to get a firmer.
Well, they need to. They obviously need to receive the update if they'd like to hear my opinion and my observations, and if they'd like to get on the situation of a twice weekly update. Again, they need to get into that. If I was short-term trading, obviously I said it right in my market update this week. Obviously, if I think 27.90 and 28.50 is the zone of selling, then I would be short. And obviously, where would I put my stops? Above 28.50 and see what happens on the downside. So far, it's been a good day.
You cover at 27.90.
Yeah, there you go. So, I mean, bottom line is you went into the zone of selling. You went into the zone of selling, which I put right in the weekly update. And basically, that would be a sell zone. Now, where could possibly be a buy zone? Again, 26.40, those highs, 24.50, 25.50. Again, if you break 24.50, you take your bullish hat and you put it on the sideline and put your bear hat back on, because it's going to open something has occurred. If we break 24.50, something has occurred, meaning the claims numbers have jumped up too high, meaning the PPP program's not working, which means we're not going to go back to work till June or July, because the guy from de Blasio, New York today, says if he doesn't get tested, it could be June or July before they reopen New York City. So the bottom line is the news is a very evolving situation here. And as the news evolves, obviously it's going to affect things. Right now, you would imagine the news is going to turn negative because the rally up to 27.90, 28.50 has rolled over. Now we'll have to see. But the bottom line is the pullback, it has not taken out 26.40. So it's a little too early to put the bear cap on. But it's certainly today, it looks very intelligent to be on the sell side. And again, you have your high. Now, if we take out the 28.50 area, again, where's the next logical spot? 61.8 and the 200-day moving average. And where's that neighborhood? That neighborhood's around $3,000. So you got to be flexible, as you know, when you're day trading, Michael. If you're going to be, an inflexible trader, you're going to lose some money.
If you're going to be inflexible, you're going to lose a great deal. In fact, you'll blow out your account on day one.
Right.
I agree. But what I'm basically trying to just include in here, I think there are a great number of people that need that assistance because they do have the larger, longer term positions. And some of them are, working family money, et cetera, et cetera. So they need to have that view, which you're extremely qualified to do. And I think that I'm also qualified to do simply based on my experience. What my point here is that for those that are looking to get in and out of a market and not carry that overnight risk anymore, then a very opportune, there are great opportunities right now in both the futures market and the equities market to put on small swing trades or to just day trade. And in that case, you are going to want to you have to switch your initial strategy just a little bit because you're not really looking for a 50 point, no, I should say more than that actually, 100 or 200 point move in the market on an intraday basis, although we are getting them now, which forces you to actually pay more attention to, VWAP levels, points of control, a high point of control, a low point of control. Yesterday, what happened in Globex. There's a lot of other factors that get shifted over and you must pay attention to. And moving averages are huge. They're a major factor in my daily trading. And if you don't pay attention to them, then you're going to miss out because again, being that the markets are quantitative, being that they are algorithmically controlled at the moment, that means when a computer sees that break, it's just going to push all of the rest of their buy orders through, if that's what's online, and then it's going to go much higher. So you can't get married to a particular side, like saying, well, I'm bearish. It's like, fine, you can be bearish if you want to be, but this market's going to go right up and blow your account out while you're still bearish, and then still come down and do what you thought it should do. So there's a lot of advantages to trading intraday and being flat at the end of the night. But don't be fooled by what I'm saying as well, because I also have core positions. I also carry little swing positions, like I'm looking for a particular market to do something. And it might take a week or 2 weeks for that to actually unfold. So you go in and I might put the position on at prices that I like, and then I just sit back and wait. But for day
I tell you, the
trading,
other things that told you that it could roll over today was it was a junk rally. What does that mean? That means the airlines were rallying last week. That means the hotels were rallying. Carnival Cruises was rallying. Now, why the heck would that happen? That would happen because of order imbalance. Everyone got out of those stocks. We had American Airlines go down to $9. And obviously, if you get any kind of news that even sounds any good, you're going to get a massive short covering rally. The problem with short covering rallies is if there's nobody to buy behind the short covering, that means it'll fall under its own weight. And that's why you see American Airlines down 7 or 8% here today. So again, if you looked at the leadership, of that, it was centered around what they call the epicenter virus stocks, which means the ones that got hit tremendously. And obviously the short covering rally is not going to last forever. And a good place to stop was where it stopped. So again, the junk rally was also a problem. And again, the VIX, I've been doing this for decades. When the VIX is at 45, you got a 3% volatility possibility. Well, I look at the market today, 2 to 3% move.
And we got it. And we actually get it. So no, I agree with everything that you've added. What I will say about today's rally, it is very selective, particularly in the NASDAQ. It is extremely selective, and it's Amazon, Advanced Micro Devices, Netflix, and Tesla. And so when I look at those things, I'm like, Amazon I can get, yep, I like it, but Amazon is now within $50 of its pre-virus collapse high. $50. That to me, you talk about overkill, Jim, that's like, okay, folks, I know Amazon's going to make money because they're the only ones that are able to get stuff out to people, and it's going to continue. So I get that one, but Tesla, I don't get. Netflix, everybody's going to watch Netflix, I get that, but it becomes overkill, as you stated. It becomes people are overdoing it because they're so desperate. They're so desperate to get back to making money. And I think that if they just kind of settle down, get some additional knowledge, get some additional tools in which they can trade and make money, then it's going to take a lot of that pressure, for lack of a better word, that really kind of hurts people. And I think that what we're both saying is very strong and very true. And I think people can really blend all of these things and come out winners in all of this, and not be so hooked into what CNBC says or what is coming out of the big banks, that they can see it for themselves based on the knowledge or the information that people such as myself and yourself, Jim, put out there for people to digest.
Well, the other thing I would warn people is that people have a propensity to act. And, sometimes it might be better to gather your information before you just act. And particularly in this kind of environment, because when we're way down at 2175, the propensity to act is going to be to sell. And then when you rally up so strongly and everybody starts thinking the worst is over, the propensity is to buy. And again, sometimes it's better to not act and shall we say, put a hold on your keyboard and just, don't act for a while and see how things pan out, because there are many, many balls in the air. And like I say, it looked very good on Friday, So, I mean, if you were long on Friday,
Right.
you know, you're already down 50 points on the S&P or 60 points at some
Right.
points. So the bottom
No.
line is you can go through a lot of money, you know, simply because there is so much hitting the fan here between the stimulus and the unemployment rate and when we're going to restart and how the
Right.
consumer psyche is going to be and have we changed our pattern of spending. And so there is, you know, there is so many big unknowns that
Right.
sometimes the propensity to act, which is a human behavior, has to
Mhm.
be put in check, because you know, you don't want to churn around a lot of money and then not be around for when there's actually a trend. You know, until the VIX, in my view, gets in the 20-30 range, I think that you're in a market that can go up or down on any given day very, very quickly. So if you're
Absolutely.
Jack be nimble, Jack be
Absolutely.
quick, God bless you. But, you know,
Here's something else that I want to just kind of stick in here, that to believe for 1 second that the coronavirus is over is a huge mistake. We're all tired of it because we're tired of having to stay in our homes and not being able to really go out and not being able to do the things that we normally would do. That I agree with too. We get a little antsy, we get a little cabin fever, but please do not be fooled. This market didn't go down because we had this huge coronavirus. May have, that's what they got tagged with, but the economic fallout for corporations, for municipalities, has not even been scratched on the surface to find out how deep it's really going to be. So I think that what's more important is not to be worried about the rally, but to be looking at what essentially is going to happen to the economy. We know that it's come to a dead still. It stopped immediately in its tracks. And what does that portend for the retail sector, for the public service sector, for the sectors that have all the restaurants that have food services within them? All of these different sectors have got to, you know, it's time to come to grips. It's come to Jesus moment, you could say, because that's where I think that investors are not looking clearly. Yes, we all want this to be over, but you cannot restart an economy that came to a dead stop overnight, because people are not going to run out and say, okay, everything's all right now, because they know better now. They know better. So that's what the market is going to try to factor in. But remember, algorithmically, they don't care. As long as they're making money, as long as their computer says, yep, I bought it here and I'm selling it there, and I sold it there and I'm buying it here, that's off their sheets and they go on to the next trade. We either need to do that, or we need to be better prepared to realize that being necessarily down 455 is not necessarily super bearish. Because again, as Jim stated, volatility tells you we could have an up 1500 day and it's not really bullish. And there's no panic. Things are trading very orderly. And I've noticed that on big down days as well. It's not that they're panicking and hitting every bid. It's very orderly done. Now, we will get into panic. Don't misunderstand. But the volatility is just providing a lot of opportunity at the moment. And that's what I think people should wrap themselves around, rather than I need this price or I need that price. It's like, just trade what's in front of you and trade with what Jim has mentioned, the volatility in mind, so that you're not buying too much premium. Maybe you need to be selling the premium, et cetera, et cetera. And when you can put all of that together, and it will help you to remain calm, and it will help you to remain focused on what is at hand and what you need to do. And that's really where both of us, what we're saying, comes into play. Because if you're just trading and you're trading quantitatively versus emotionally, you will be the winner. You will be the huge winner, and it'll happen every day.
yeah, with the VIX at the high levels, the option buying is a little bit more difficult, obviously. So that's why I
Yes.
say when you get a VIX up at this level, you know, again, the propensity to act might have to be put on hold, because this is a very
But I
difficult
like your
environment
idea of
for,
selling puts.
you know, for putting up 50 points of premium. I mean, they were just talking the other day, which made a lot of sense to me, that, you know, Apple as a buy right made a lot more sense than just buying the stock. because
Yes.
they were giving like 15 points on another company. They were giving 30 points of premium. So the bottom line is, having that as a downside protection is not a bad thing, and it still gives you upside potential. So, covered call writing down here is probably not a bad thing to investigate, because these premiums are very large, which means you still have upside. And then at least if it does roll over, you've got some kind of a cushion offsetting the risk on the downside a bit.
Right. I
That's
like
again,
selling.
like I say, knowing what strategies might have the better probabilities or might be more in tune with what you're trying to do is very important. And
Right.
if you don't have a, shall we say, a affinity for some mathematics here and an affinity for understanding the different strategies, then obviously that's a problem. But again, with
Right.
this kind of with these kind of premiums, the two things that come to my mind is covered call writing and put writing on stocks you want to buy. Those are the two strategies that hit me the most. Because
And
why? Because the odds are, when you're at a 45 VIX and the premiums are obviously very, very, very large, obviously the guy who's writing them may have some advantages with certain types of strategies. Covered call writing, you own the stock, you're agreeing to sell the stock at a higher level. That ain't a bad thing. And then you're going to get paid a very large premium. That's not a bad thing. And then on the
right.
put side, if you have companies you like, but you don't want to buy at current levels, you look to the lower strike prices. You see how fat those premiums are. You find a strike price you can sleep with, minus that big fat premium. That's not a bad probability. So that's what you
Right.
try to what? That's what you try to investigate and try to use the market to your advantage rather than
Right.
having the market use you to its advantage.
Well stated. Well said. I agree with you. Should we move on to other questions?
Well, like I say, predicting where the market's going to be on Friday is a rough racket. So obviously we've already, you've done that. And, let's hope that, like I say, the direction that it's on Monday is actually where it might be on Friday. But in this world, it's hard to say.
That's true.
With regards to, I would like to look at these are a few ETFs that I'm watching and focused on for when we come out of this thing, because these guys have done pretty good. So let's start out with VCR. And there are many different ETFs out there. I'm just using this as an example. This is the Vanguard Consumer Discretionary. And some of the stocks in this thing is your Amazon, on your Home Depot, Max, Lowe's. And, again, if the consumer is going to come back, consumer discretion, this is VC, this is a consumer discretionary. This is one that I keep an eye on for, creating some type of a little portfolio of a high beta nature that could be reasonable to look at. And another one that I am focused on here a little bit would be VGT, which is the technology. And there you're going to have your Apple and your Microsoft and your, Intel, Cisco, NVIDIA, Salesforce, people like that. And this is another one that obviously, if the market comes out, would be one to try to keep an eye on. Another one is MGK, which is another, volatile it's mega cap growth. So it's going to have the big guys in there: Amazon, Apple, Microsoft. A lot of them have similar stocks in it. Again, if you want to get the growth, it does seem like the NVIDIAs and the Salesforce and the Amazons and the Apples and the Microsofts are where people are focusing. And
Are these value weighted or
no, well,
price weighted?
they're weighted by percentage of the ETF, meaning to give and obviously their weightings are dated. They don't give you right to the minute,
Okay.
but yeah, they have different they have different amounts of money in each one.
Right.
And then the last one that I'm keeping an eye on here is SMH, which we know is the semiconductor. And today it's up. So,
Nicely. Yeah.
Again, because the idea when we come out of this thing, the 5G story is not going away. The cloud story is not going away. The edge computing and the cybersecurity, these stories are not going to go away. And while spending on certain items may certainly get pulled back, maybe some of these things, like cloud computing, et cetera, will not get pulled back, and or not as much. And that's the idea. That's why this is a high beta thing. You can see it's a little bit more volatile than the general S&P.
Right. Right.
But these are some of the different areas that I'm keeping an eye on. You want to put up? Can we put up TLT? Because then we can talk about what we think the interest rate market's going to be doing. And you watch this quite a bit. What do you think here on TLT, Michael?
Well, let me hold on, because I'm going to use one of my charts instead of that one. And for TLT, I think that, me personally, I do not believe that interest rates are going to once again bail out the economy. I mean, they've already gone to zero on the short-term paper, which is, T-bills.
Well, look at that chart. I mean, that chart went up to 180. Do you think that 180 is going to be, shall we say,
challenge?
The top of the Empire State Building, that little needle that comes up that you never can get to, or what do you think?
Yes, that is actually what I do think. I think that TLT on my charts topped out at 179.70, which I think is going to agree with yours, which is right that 180 level. The 30-year bond one day last week was trading at 182 and above 182. And then as soon as something clicked, as soon as whoever had to have those bonds, which was obviously someone with a lot of money, some big corporate bank player, they collapsed and they went all the way back down to 178. And now they're just kind of waffling up and down around that level. I think that if we take the assumption that the markets are always perfect, they're perfectly priced, and that's where value gets put in and things get taken out. Now, whether I agree with that level doesn't really make any difference. So can the bonds or can TLT go back to 180 and above? Yes, they can. And that would be likely based on the fact that the Fed goes negative. They take interest rates negative.
Well, I watch corporate bonds quite a bit, and some of the short-term paper out of the banks actually had negative yield, meaning less than a year, 6 months. So they've already gone negative on some of these things. So to be honest with you, that's pretty whack.
20-year pluses. So for them,
this isn't going to go negative. I mean, I don't think this is going negative on 20-year bonds, but you can never tell.
I know, right? I would agree with you. It's like, I wouldn't dare. So every time it got up to 180, I'm a seller. And based on the fact that I don't think that they will ever go negative. Stranger things have happened, and we may see it again. But again, we're not anywhere near that type of a decision being made. I would think that the markets and everything would really have to start to collapse before we'd see them, pumping these things.
You're right, Michael. The decision was made to, rather than go negative yield, is to set up 9 million programs where the Fed can funnel money, and then basically the programs can do whatever they want with them. So, right. And that all that does is make the balance sheet of the Fed go up towards $10 trillion from $4 trillion in 3 to 6 months. So, that's the tactic is not to go negative interest rates. It's obviously to set up programs to buy assets.
Right. And I think that, and because it's a very important statement that you just made, but I'm going to just add to it, and you correct me if I'm wrong in adding this. This is not going to happen overnight. What Jim is making reference to is probably at least 6 months to a year before consideration. We've seen the Fed, pump a ton of money, and we've seen Congress pass these $2.3 trillion rescue packages, and they're going to have to come up with more. And those are the unknowns that remain out there. But I think more importantly, with these bonds, we saw the run, the flight to quality, as they call it, until you suddenly realize it's like, what is the quality? when I
Yeah,
give my
the
money to the
supply of
federal government,
treasuries is going to be very, very large. What you're talking about is, so it's not the credit quality because they can print money to pay you back, but the value of the bond. If there's 9 million zillion out there,
right,
obviously there's concern about dilution.
right,
Another thing is some of these ETFs that benefited last week from this news report have already given back quite a bit.
right,
VCSH is a short-term ETF corporate, and it rallied all the way from 72 to 84, and it's back at 80. And then
right,
MUB, and the big story really is the cities, the states, and the
right,
counties, because a lot of these guys have balanced budget mandates, and
right,
their budgets couldn't be more imbalanced if they wanted to be, because their tax revenues and their revenues from all different sources have fallen off a cliff, and their expenditures just keep coming in like a tidal wave, not to mention their unfunded pension liabilities. So if the
right.
Fed's going to be printing a lot of money, it's definitely going to be going to, I think, the states and the cities and the counties, because
So
they're
that they don't go bust.
yeah, because they don't go bust, and obviously that directly affects the citizens quite a bit.
And
You
this
know,
is something else that I think this is important things that you're talking about on what the Fed can do to pump up because we need to protect the states and the municipalities.
mm-hmm.
But understand that doesn't necessarily mean that they're not going to fail. And I think that these are the things that we must keep in our mind when we're moving forward. And how do you want to position yourself and what do you want to do, particularly with interest rates? What do you want to do and how do you want to do it? And what's going to change your mind and what could logically happen? These are important things that I think people need to learn about and factor in if indeed you want to protect yourself against what could likely be sitting in front of us.
Yeah, I mean, again, most of these things have had big run-ups because the Fed came in. That includes mortgage-backed securities like VMBS, which is a ETF as well. But
Right.
then again, that that has rolled over a bit. So, and then again, the leveraged. I mean, the closed-end funds were trading at a 20% discount to NAV. They're still 10% a lot of cases. And then
Right.
the PIMCO funds like PCI. That went all the way from 26 down to as low as 13 and change, and now it's back to 18 and change, but today it's down 5%. So what we're saying here is that initial enthusiasm and short covering
Mm-hmm.
is abating, and the question is will the money get to these things soon enough, and does the Fed really have the wherewithal to back the entire situation?
Right.
Because these leveraged income funds and these debt instruments that had very bad covenants, they are being exposed. And again, how many holes can be plugged in? The other thing people are saying is the Fed's turning on the water, but the pipes that get the money to where they're supposed to
Are
go
rusty.
have a lot of holes in them.
Yeah, they're
And
rusty and they
yeah,
have holes.
they're
They're not.
rusty, and there's holes in them. And like I say, I think
Yes.
this PPP program and small business, there's two risks to that. One is obviously that the money doesn't get there very soon, and the second risk is some people might say, "Listen, this is a bridge loan for 2 months, and then I got to pay these employees again." With no business coming in the summer because
Right.
people still are not moving.
Right.
So again, it's a situation where some people, I understand, are not even going to go for these loans. They'd rather just cut staff. So, like I
Right.
say, a propensity to act right now could be more dangerous than anything you could do. So, sometimes,
Agreed.
letting the flow of water, move down the river a little bit before you start making any major league bets is probably not bad suggestion.
I do agree with you on that. I think it's a very good analogy. Thank you.
Okay, well, let's turn over to what you like to talk about, and I certainly have been watching, and that's the gold. And give me your view on it, and then I'll coincide with mine and see what you think.
I am, of course, I am long-term gold bullish, long-term, but I always have been. But I play it, I think, a little bit differently. Right now, we have now hit a new high at 1764.50, and that just happened as we were talking there. And the market again is approaching a pretty solid overbought reading, and I'm looking at a weekly chart, which is telling me it's overbought. If I go up to the monthly and take a peek at that, and again, I'm looking at the cash market versus GLD. And GLD, let me count. Hold on. That's 1, 2, 3, 4. Yeah, we got a little bit more to go, but I think that GLD is going to have to do a little bit of correcting here before too long. On the monthly chart, it still has room up to that old high at 1923.70, which was way back in 2010 or 2011. And that is the anticipation that'll eventually be broken. But I think just on a near-term basis, which could really be the next 3 months, on a near-term basis, I think that gold can really correct. And if it starts to correct, I mean, Jim, you tell me, on the monthly chart in gold, which is, you know, the continuous futures market, I got the 200-day moving average at 11.12, 111.12. Excuse me, $1,112.20. That's where
on what chart is that? A monthly? Or?
Monthly gold.
Okay, yeah, on a monthly, yeah. The yearly, I think, is at 1485, something like that. But either way you look at it, one is $300 above the average, or 20%, and the other one is even further. But again, there's a reason for it, because obviously there is a very big concern. Inflation will be coming back. But of course, inflation coming back has been waiting for Godot for a very long time. Again, when you have this much debt, I mean, basically we had a big margin call, guys. That's how it works here. The whole world was over leveraged, and they had very, very little cash. Why did they have very little cash? Because they bought all their stock back with their cash. So how did they get left with no cash in the coffers? They got left with no cash because they spent it. Now, what happens when you're over leveraged and you have no cash? If you're an individual or a corporation or a government, you got a big margin call. And that's what happens when we drop. And that's why nobody's in there buying from the dealerships, right? Because nobody wants to step in front of a massive margin call except the Fed, who's using funny printed money, right? So bottom line is, now somebody's met the margin call a little bit, and that's why you got some stability. But if the trend is still down on this stuff, there'll be another margin call coming. And that's why the Fed is saying we have unlimited monies to keep meeting these margin calls. And that's what's supposed to make people more comfortable. Now, the Fed may have unlimited money, but does Asia and does Europe and Latin America, do they all have unlimited money to keep meeting these margin calls? That's a big question.
They may show up at the door and borrow it from us.
Yeah, I mean, so I mean, we don't know where the story ends. But as far as the gold's concerned, you know, it is really strong. Only a blind man couldn't see that. It's very strong. But again, like you were saying, it hasn't taken out those highs of around 1800 and then 1920. So you got 2 more levels of which could be some resistance. And then you were saying the moving averages on the monthly are obviously, and if you connected the bottoms from 2015 and then the low down here in 2018, and you drew some kind of a line, it gives you a little bit of an idea of, you know, probably around where those averages come in, right?
Right, that's true. I'm taking a look at GLD on the daily chart. Now, you know, it's again just making new highs here, not new all-time highs, but just, you know, on a day-to-day basis at just below 162. It's come up to 161.99. I think that's really a fabulous rally, but I think if anything, we could get a pullback, and if we get a pullback, our first level to really keep an eye on is 156. Then we get 153, then we get 150, then 147, and then 142.50. So those are pretty strong levels, all coming all the way down.
Yeah.
And if it breaks below 142.50, then it's breaking the 200-day moving average on a daily basis. And that would portend that we're now going to go make new lows below what we've just seen in March at 135, 136.
What about if we can throw up one thing before we close out, GDX, because today it's up 5%, which is a great move. So that's a good thing to see, is that the gold stocks are moving up. And then on the other
True.
side of the coin, the reason it's not as great is you still haven't taken out the 32 level. So if we cannot
Right.
get
And I
above
think
1800, yeah, if we cannot get above 1800 and you cannot get above 32 on the GDX and you start seeing it roll over, that would be two warning
right.
signals that we are running into some resistance. So you got two great lines in the
Learning
sand
into
up here.
resistance. But also, I think that when you're trading the GTX, which is gold miners,
GDX, yeah.
I think it's very important to also remember that gold miners, they have a per troy ounce number that they need to keep. That below it, they don't make money. Above it, they make money. And so if it's above it, they'll continue to mine. They'll go get that gold out of the ground because they can sell it. If it falls below, it's costing them too much money to get it, to go refine it and to get it out of the ground. So I think that we need to bear that in mind. And that was substantially part of the reason that we had that huge drop from what, about 29.50 all the way down to 16, was the fact that somebody finally realized and said out loud, they're not making any money. They can't make any money because they can't get it out of the ground and then sell it for a profit. So they're not going to do it. So we saw a lot of mines really begin to slow down and shut down. Now that's back in play, and I have seen a recommendation that people say move back into the mining stocks, and then boom, we see the rally. Again, now you need to be more technical about it, and you need to watch to see, will it essentially get up and break 32, which
Well,
is
I
going
mean,
to put it above.
if that happens along with a break above 1800, you're going to be in a situation where we're into the uncharted territories a bit,
Right.
and you could really accelerate. We're at the
Right.
top of the hour right now, Michael. I want you
Okay.
to let people know how to get a hold of you, and again, some of the things you're doing down there at Logical Signals.
You can get a hold of me by sending an email to michael@logicalsignals.com or michael@mjf1partners.com. Both will come to me, and I enjoy getting emails, and I always answer them. So if you have questions or just want to make comments, please do. Secondly, I'm going to be getting my website open again. Please make sure that you're on my website or on my mailing lists. And the reason being that this is part of it getting redone for me. But get on the list, because what I intend to do once I start making daily analysis again, I am going to be offering that out as a free trial for at least 2 weeks before I would then begin to charge for it. And I'm not going to be charging a lot for it, but I think that it becomes a little bit easier to manage if it's just to a select group that are actually, putting some money down to get it. And I'm looking at maybe like $14 a month or $99 a year to receive this. So, and again, the focus will be primarily on futures and options and day trading.
Okay, sounds good. Again, I'm with the Option Professor, and again, we have a weekly update. If you haven't been receiving it, I think you have missed out on quite a bit. And also, we're going to be considering a twice weekly update during the week because of obviously where we are with volatility and where we are in the market. So again, Option, OPTION, Professor, PROFESSOR, at gmail.com. That's how you can get access to the weekly update. And also you'll be notified if and when we go to that twice weekly market update as well. Obviously, I cover everything from the stock market to the bond market to the US dollar, to crude oil, to the metals, and also agricultural. So there's a lot to read and a lot to soak in. Also strategies for hedging, asset allocation, percentages, and things like that. I've been doing this for decades, so I do have a certain amount of product knowledge, and I share it with you. So again, optionprofessor@gmail.com. Shoot us an email and get on board. Right now, I'm going to turn it back over to David Kosmeter.
All right, thanks, guys. Lots of good info today. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app or directory. You can also go to TimingResearch.com to get access to the recording of this show or any of the past shows. And be sure to join us tomorrow for Analyze Your Trade at 4 p.m. Eastern Time. Anka Metcalf will be back to analyze your trade ideas. And Jim will be here to moderate again. And just want to thank my guests again for today, Michael Filighera of LogicalSignals.com and Jim, the option professor at optionprofessor.com. Thanks, everyone.
Thanks, David.
Thank you.